All right, today we're going to pull back the curtain on how the world's most sophisticated investors are not just surviving, but actually thriving in this crazy high inflation economy. We're going to break down their strategies and, even better, show you how these tools are no longer just for the big guys. Let's get into it. So let's just start with a really direct question, because it gets right to the point. Why is that balanced portfolio you've been told to trust for years suddenly broken? For a whole lot of people, the answer of the last few years has been a pretty painful yes. And the reason why is actually pretty simple. The entire economic world has shifted under our feet. You see, the old world, the one where the standard portfolio advice came from, was all about low inflation and falling interest rates. But that's not where we are anymore, not even close. We're in a new world of sticky inflation and much higher rates, and that means the old rules just don't work. I mean, for generations, the 60-40 rule was basically financial gospel, right? You put 60% of your money in stocks for that nice growth, and the other 40% in bonds. The bonds were supposed to be your shock absorber. The idea was, when stocks zig down, your safe, steady bonds would zag up, and you'd be cushioned. But in the wake of the pandemic, that entire strategy just failed. It failed spectacularly. Inflation shot up, the Fed jacked up interest rates like we haven't seen in decades, and what happened? It crushed both stocks and bonds at the same time. Suddenly, the cushion was gone. That so-called balanced portfolio was anything but.
And that brings us to the most important point of this whole conversation. To actually succeed now, you can't just keep using the old playbook. You have to start thinking like a major institution. Like a huge pension fund or a university endowment. They thrive by using assets that don't just protect them from inflation, they're literally designed to profit from it.
Okay, so how in the world do they do that? Well, it really boils down to three core pillars. Think of them as three classes of blue-chip alternatives that are built from the ground up to get paid by inflation. Let's break down each one.
Pillar number one is what we can call the inflationary contract. We're talking about institutional real estate. Now, forget everything you've seen on TV about flipping houses. The pros focus on one thing, the income stream. Why? Because a commercial lease is basically an inflationary contract. As the price of everything else goes up, the property owner can raise the rent, directly passing on those rising costs.
The single most important metric the pros use to value these properties is something called the cap rate. You can see the formula here. You just take the net operating income, or NOI, which is simply the rent you collect minus your expenses, and you divide it by how much the property is worth. So as rents go up with inflation, your NOI goes up, and that directly pushes the value of the property higher.
And this right here is the real profit engine. See, institutions will often buy these buildings with long-term fixed-rate debt. So their biggest cost, their mortgage payment, stays exactly the same for years and years. But their income, the rent, goes up with inflation. That growing gap, that delta between their fixed cost and their rising income, that is pure inflation-fueled profit.
Now let's move on to pillar number two, which builds on this idea. The floating rate fortress, better known as private credit. Now, think about it. If you own a normal bond, rising interest rates are your worst enemy, right? It crushes the value of your bond. Well, private credit completely flips that dynamic on its head. This is where you make direct loans to companies, but the interest rate isn't fixed, it floats.
Here's the simple version of how it works. The interest that the company pays you is tied to a benchmark rate, something like SOFR, which moves up and down with the Fed's main interest rate. And on top of that, you get a fixed margin, called a spread. So when the Fed raises rates to fight inflation, that benchmark rate goes up automatically. And guess what? So does the interest payment that lands in your pocket. Rising rates actually become your friend.
The benefits here are pretty huge. First, you have basically zero interest rate risk because the loan's rate just adjusts upwards. Second, you're almost always getting higher yields than you'd find in the public bond market. And finally, and this is a big one, this whole asset class is now accessible to regular investors through things called business development companies, or BDCs. You can think of them like mutual funds for these private loans.
And that brings us to our third and final pillar, which might be the ultimate tangible hedge, farmland. I mean, think about it. It's a finite resource, they are not making any more of it, and its value is driven by two of the most powerful, unstoppable forces on the planet: a growing global population that has to eat, and the rising cost of food itself.
And farmland is great because it gives you two completely different ways to make money. First, you get a stable, almost bond-like income stream from the farmers who pay you rent to grow their crops on your land. And second, the value of the land itself goes up over time because an acre of land is directly tied to the value of the food it can produce.
As food gets more expensive with inflation, so does the land.
And here's the kicker. Historically, farmland has delivered really strong returns, but with way less volatility than the stock market. Why is that? Well, its performance isn't tied to what some CEO says on an earnings call. It's tied to real-world stuff, like the weather and global demand for food. It's a true diversifier.
Okay, so we've covered what these institutional assets are. But that leaves the big question. How can a regular person like you or me actually invest in them? Well, the good news is a whole new wave of fractional ownership platforms has opened the door. But you absolutely have to understand the rules of the game.
And those rules are set by the SEC. This table kind of breaks down the big ones. At one end of the spectrum, you've got Reg D. That's for the big blue-chip offerings, but it's only open to accredited investors, the wealthy. On the total opposite end is Reg CF, which is for really small, early-stage deals. And right in the middle, you have this sweet spot called Reg A+, which is kind of like a mini IPO. It lets anyone invest, and most importantly, it requires a much deeper level of review by the SEC, which gives you a lot more transparency.
So, before you even think about putting $1 into any of these alternative investments, you need a super simple but really powerful due diligence checklist. Honestly, it just comes down to asking two critical questions.
First, what's the liquidity mechanism? You have to remember, these are not stocks you can just sell in a second. You have to ask, how long am I expected to hold this? Is there any kind of secondary market to sell my shares if I need to? Illiquidity is the single biggest risk, so you need a clear answer. And second, what's the regulation? For most of us who aren't accredited, a Reg A+ offering is probably a safer place to start, just because you know that company has had to go through a much tougher review process with the SEC.
So here's the bottom line. The game has totally changed. For the first time ever, you don't have to just sit on the sidelines. By understanding these three pillars, institutional real estate, private credit, and farmland, you can actually build a portfolio that has the same kind of structural, inflation-proof protection that the world's biggest funds have been using for decades.
Which really just leaves us with one final question to think about. I want you to take a hard look at your own investments and just ask yourself this. Is my portfolio built for the economy of the last decade, or is it really truly built to thrive in the decade that's coming?